Welcome to another edition of Wealthy and Wise. I'm your host, Adam Kente, and today I brought in an absolute expert to help us decipher the codes of how to have our business taxed. And there's always been a debate about should your LLC be taxed as an S Corp, C Corp, partnership, what really makes the most sense. If I have a corporation, should it be a C Corp or an S Corporation? And there's some really basic principles that we follow in determining, and we can always make changes as well, but basic principles that we follow in choosing a tax election for the business. So we brought in Brian Hawley, who has been with us for, I don't know how many years, Brian, years.
16 in the industry, yeah.
16 years. So you're an expert on making sure these things get set up properly. And not only do you help our clients with that part of it, but you continue to work with our clients. So I'm sure you're in the same mindset of I don't want to get a call a year from now saying, hey, why didn't you tell me that this was an option and doing things the right way? So when we form an LLC, give us kind of a background or the basics on what happens and what's the process from when we get an EIN number. How long do we have to choose how we want to be taxed?
Yeah.
What's that process look like?
Yeah. So essentially, when one forms an LLC, the IRS or the taxman, which is local, state, and fed, you're allowed 75 days, right? 2.5 months if you're doing the math, to choose a tax election. Okay. So a tax election in this arena, election is the same word as decision. So I elect, I decide. So it's whatever you'd like to decide. So using an LLC as an example, LLCs don't have their own tax code. So it's a good example to start with. We'll get to corporations too. But so LLCs, when I say they don't have their own tax code, if one CPA ever says, oh, is your LLC just taxed like an LLC? That language doesn't really make sense. It doesn't exist. So LLCs are either taxed like a partnership, disregarded, and ignored altogether. So between you and the taxman, it'll just kind of look at it, choose, and whistle. But but it'll still have all the asset protection. So between you and the judge, you can't sue them. They just work here, right? So it could be taxed corporately or non-corporately. So that includes S Corp and C Corp on the corporately side, and non-corporate would be like a partnership or disregarded altogether. So you have 75 days. So the process is you form an LLC, you get the EIN number. The EIN number is just like your Social Security number would be for you as a taxpayer. It's the taxpayer identification number for an LLC or a corporation. And then from the formation of the entity, not the state of the EIN, the tax ID number, it's from the formation of the entity that you have those 75 days, right?
Got it. So I form the company, I get the EIN number. The IRS says, all right, you got 75 days to decide if you want to change how this is being taxed.
And if you don't decide, a decision will be made for you. So the default position we'll go into, so if a decision isn't made by the business owner, one will be made for them. And that would be that, hey, if I'm a single owner to an LLC and I want that asset protection, but my tax situation as a sole proprietor is what I want, there's a lot of reasons that could be. One example would be maybe it's passive income. And you have a stack of cash right here where I'm lending that to somebody else. And the interest off of that, as long as the term is longer than a year, is passive. Or I have a rental, even more simple situation. My tenants, whatever is above principal, interest, tax, and insurance, my mortgage payment essentially is going to come back to me as passive income. I don't want that corporately taxed, right? I want that asset protection that the veil of an LLC will afford me without messing with my perfect tax situation as a sole proprietor, so that income could hit my tax thing. So I want to leave that alone. I want that disregarded for tax purposes. So when that happens...
Well, starting off with, so I have a disregarded entity. You said passive income is a great example of when we would do that. Or if maybe you and I went into the business together and we bought a rental property or some type of passive activity.
Yeah.
We'll do it as a partnership.
Exactly.
But the S election is probably one of the most critical pieces of do or don't, because this can either save us a lot of money or cost us a lot of money.
Exactly.
So generally speaking, when do you recommend LLC go ahead and do the S election?
Good. So like you said, if there's two people doing passive, it's automatically going to be a partnership. But then moving into the corporate side of things, so an S tax election is kind of an altered C election. So C Corp is just your regular old corporation. So the S Corp allows one to be taxed corporately, but not have corporate taxes. So you have all the corporate write-offs and everything. But when it comes to the profit or loss, it's passed through to the shareholders, to the owners of the LLC or corporation, to them personally, and you pay personal taxes on that. Now you have to payroll yourself, right? So your question was, when does it become advantageous or not so advantageous to be an S corp regarding on the entity that you have? So speaking with an LLC, moving from either a partnership or a sole proprietorship to that escalated part of corporately taxed, and then if you're a small business corporation, the S corp, that would be where you're making enough money to pay yourself a reasonable salary through payroll, right? Which is the same taxes as being a sole proprietor, and then have enough left over to where not having any 15.3 self-employment tax, yada, I could go into detail, but not to have those extra taxes hit your distribution as a shareholder. Because when you're an S corp owner, you're really two people, right? You're the employee and you're the business owner. It's the business owner, that distribution of profit that comes to you as a business owner where you don't have those extra taxes. So again, to simplify, if there's enough money to pay yourself a reasonable salary, and then through payroll, which is the same taxes as a sole proprietorship, but then have some left over to where you're not getting those extra taxes, to where you save a roughly 15 cents on the dollar on that portion. And that adds up to be enough of worth doing the extra filing, which isn't that big of a deal once you get your head around it. But new people are new to things, hence my job here at NCH.
Well, I was literally just got off the phone with a doctor, and he makes decent money as a doctor. He, as a business consulting, a medical consulting business as well. And he said, Adam, I talked to my friends and they said that I really don't need to be taxed as an S corporation, that it's extra tax filings and payroll and things of this nature. I said, well, how much is your business going to make? He said, well, we'll probably be on the side hustle business an extra $500,000 to $700,000 this year. So in addition to, you talked about saving money in self-employment taxes by having that S election, in addition to that, what other benefits do we get being an S corp versus the sole proprietor?
So really for me, it's about taxes, because the LLC is going to be an LLC no matter what. It's going to have, LLC is a hybrid between a corporation and a partnership. So you get that corporate veil, right? That corporate protection, but the easeability of running like a partnership if you choose. But if you go into that corporate taxation, what other benefits you get as a C corp over that other than taxation? I really can't think of any, because that is where it's at. You have two sides to the coin for corporate structuring. You have what's going to happen in front of a judge, and you have what's going to happen in front of the tax man. So when we're talking tax selection, it is squarely in the tax man standpoint. So if he's doing an extra side hustle, the extra, what did you say, $500,000 or $600,000? So that if that's a side hustle to somebody, that means they're making that much or more in their other life, in their career. And some of those taxes that you save on as being an S corp, about 12 point something percent of that 15.3, which is your Social Security, that caps out at $147,000.
The 160 this year.
One sale, they raised it up 13. Okay, yeah. So 147 is 22. You got to the new tax laws before I did. Good job. And so yeah, 160. So that's good. So 160. So he's already capped out. But the Medicare portion of it, which is 2.9, I believe, right? That doesn't have a cap. So that's where this doctor in this example. But for those, that's where they'll be saving money. But for those that their side hustle isn't $500,000 and $600,000, to where, like, let's say a landscaper, right? Which is a business I used to own back in the 90s in California. So as a landscaper in California back in 97 or whatever, I was making $80,000 that was mine out of the company. So I became an S corp because the reasonable salary at that time for what I was doing was $30,000 as a manager to that company. So I had $50,000 left over as a distribution of profit to me. Good job, owner. And yeah, so I was nowhere near the SS cap at that time, which was lower than 160, lower than 120, 147. So yeah, I had the 15% savings on that $50,000. Which is where a lot of entrepreneurs, when they're starting a company, are. Not the majority. Well, yeah, probably the majority, but for entrepreneurship, especially for those that are still working their career and doing that. So what we really have to look at, and I'm glad you brought up the doctor, because that also allows me to talk about that if in your normal job, your W-2, whatever you're paying into that Social Security, that cap to reach 160 starts there and then goes into your other business.
Well, so we were talking about, I was sharing with the doctor, so the U.S. Inspector General does a report card every year of audit risk for different entity filings. And the last year, in 2021, I read the Audit risk for a sole proprietor. That means you have a self-employed income, the Schedule C.
Yep.
That Schedule C,
40, yeah.
it was at 6%, which is 1 in 20, a little more than 1 in 20 risk of being audited when you file the Schedule C. And as we know, the IRS doesn't come back this year and say, oh, Brian, you just filed your 2022 return and there's an error. They always wait about 3 or 4 years. And then they audit you.
Yeah.
And one of my clients is actually an IRS auditor, and she said, Adam, we know that if we see a Schedule C, most people, they have no training or guidance on what they can or can't write off, what documentation to keep, how long to keep it for, and we audit them, we're going to get money out of the audit risk. And there's a lot of errors. People do TurboTax, or they're sitting down with their guy at one of these chain tax preparers, and they
Fast food of tax preparation.
She said, Adam, if I see a Schedule C, I know that most of these people, when they see how much they owe, they start making up a bunch of stuff, hoping that it works. And it happens all the time. So reducing the audit risk, I thought, was a really big deal. And for our doctor, just being able to take the salary for him and his wife. His wife is the office manager, schedules all of his appointments, help with the accounting.
Right. That's where they might want to file separately, right?
Well, they're able to put $66,000 a year each into a solo 401k plan, where you've got to have a salary to be able to do that solo 401k. So I look at huge tax savings opportunity at that income level as well.
So earlier when you'd asked me, are there any other benefits to having an S corp other than that self-employment tax and other related taxes? So now I see where you're going. But on the day-to-day, if you're thinking numbers and taxes, but then there's always the living the corporate lifestyle, which is two of the things that feed right into that. And that would be, yes, you could actually do retirement programs where that is pre-tax money, depending on whether it's, there's different types. There's a solo 401k type, there's an IRA type, depending on when it's taxed. But there's going to be benefits there where you can do as an employee. Remember, you're two people, right? You're the owner and you're the employee. So as an employee, as an owner, you could say, hey, we have an employer-sponsored retirement benefit program. Are you in or are you out? A lot of people experience this at their W-2 job, but as an owner and an employee of your own company, you could also offer that to yourself. A lot of tax savings there. But in addition, you could become like in real estate, once you hit a certain level of hours and income and payroll, you could become a real estate professional for a lot of tax benefits there. But yeah, on your day-to-day, the first thing is there enough savings on your self-employment tax? And if not there, what else can there be to still make it worth it?
And I love you brought up living the corporate lifestyle, because normally W-2 employee, you make the money, you pay taxes, and you use what's left to pay the bills. But now as a business owner, make the money, spend the money first, pay taxes on what's left, and your money goes a lot further when you're using pre-tax dollars to pay for a lot of these expenses. So I love the idea of, as a business owner, making that decision for the S election. Yep, we got a tax filing. What's the deadline this year for the corporate return?
For the corporate, I believe it's 3/18, but I always say 3/15. And if the IRS gives you a couple extra days because of a weekend or whatever, your tax person will let you know. But what you always want to think in your mind is, no matter when somebody may be watching this for any year, is that it is 3/15, which is March 15th, which is a month earlier than your personal return, which we all know is April 15th. The reason for that is that distribution of profit. Here, owner, here's some money, good job. If anybody's ever had a 1099, you get a 1099 at the end of the year for being an independent contractor. At the end of the year, you as a business owner will give to you as an employee in an S corp situation. Here, owner, here's your K1 distribution. So you got to have time to file that with your personal taxes.
Well, excellent. Well, thank you so much for being here. So for all of you out there, it can get quite confusing as to which entity election to make. Please call NCH, talk to Brian Hawley. Let him go through with you all of the options you have and what's going to be best for you and your family. Right now, at the beginning time of the year is when we have those chances to make those changes. So if you've not been filing as an S corporation and you should have been, this is a time. We have 75 days from the year-end date. So now until March 15th to decide whether or not we want to be taxed as an S corporation. So that paperwork's got to come in. Thank you again for being here. Get a hold of Brian and let us help you with your tax election. Have a great rest of your day.